So what are the retirement plans that we qualify for? We'll be having the question answer session. We have a lot of wealth planners as well. Here, if we can't answer, they can answer. We'll have some fun games and we'll have dinner. That's the idea. And of course, a lot of liquor. So this is who we are. 20 years of professional experience, serving clients in all the states, all CPAs. I'll be lying to you if I say I have license in 50 states. All CPAs are allowed to practice in all states, all 50 states. So the license is not for New Jersey. The reciprocity rule. I have MBA in finance from New York University. That's a big deal by itself. I mean, from an expense perspective. I have a CPA. Series 7 and Series 66 license are the renowned license. The CPA certification, wealth planning world. When you think about the retirement planning, the wealth planning, you want to ask the person, do you have Series 7 and Series 66? If they say yes, is it active? It means they're practicing it. It means they're doing it every day. And if they say, no, I don't have the license, then you say, okay, thank you for the advice. I'll think about it. Meaning you have to know who is giving you the advice. And these licenses gives you the verification. Like if you're a tax accountant, are you a CPA? The CPA and Series 7 and 66 makes us a unique, gives us a unique proposition where we have the IIT background, the technical background, MBA in finance. Let us think about the whole business cycle. Most CPAs who have the CPA degree, you give them the number, they do the data entry. They can't think how to make the business bankable. What are the repercussions? What are the consequences of showing lower profit, higher profit? That's where the MBA kicks in. We have the financial and all these type of businesses. We have a lot of restaurants, distribution unit. Haldiram is our client. I mean, Indian people will understand Haldiram is a big deal. So Amul is our client. So I mean, there are big names from an Indian standard perspective. So this is what we do: business setup, business startup, financial valuation, of course the taxes, sustainability, merger acquisition, cash flow analysis, accounting and bookkeeping that goes hand in hand. It includes the compilation, review, and audit. And if somebody gets an IRS letter or a state letter, the idea, the intent was to provide all the services that a typical business will need from a tax and accounting perspective under one roof. So there is no finger pointing. What used to happen, people will get a notice. The notice will say payroll taxes. You send it to the ADP. They will say, no, give it to the accountant. It says tax. And when they bring it to the CPA, say, no, it's the payroll notice. Send it to ADP. So that's why the intent was to make sure everything is done under one roof. These are, when it comes to the retirement planning for a small business, each business is different. Depending on how your business is set up, the plan that you select, the plan that you qualify for, and the plan that makes most sense for you is going to be different. We have 5 types of business structure. Right from proprietorship, we have partnership, LLC, S Corp, and C Corp. As you go down the list, your protection increases, liability protection increases. As you go down the list, your cost of doing business increases. For the same transaction, LLC costs $700, this costs $900, this costs $1,200 to do the taxes. This tax return has 30 pages, this tax return has 50 pages, this tax return has 70 pages. More complication, more compliance need. But the liability protection is higher. The idea is, from a retirement planning perspective, you have to know what you have. Do you have an LLC? Do you have an S Corp? Do you have a C Corp? Depending on what you have to be doing the planning accordingly. For example, SEP contribution is 25% for S Corp and 20% for LLC. So there are a lot of nuisance that goes hand in hand depending on what type of structure you have. So retirement planning, what are we trying to do when we think about the retirement planning? So the whole retirement planning is planning for the future. So we can continue to live the same, similar lifestyle that we have. And there will be a lot of ups and downs. The plan that we have will never work out. There will be a lot of changes to this plan. Do you have some emergency fund? Do you have some rainy day fund? How would you get that fund? Is it going to be taxable when you take the money out? The plan will be qualified plan, non-qualified plan, and we'll go through the nuisance of it. We'll try to keep it simple. But you have to know, how do we get enough money when we retire? And when you get this money, do you have to pay tax? How much the bottom line here? That's what you have to be thinking about when we think about So when we think about the retirement planning, of course, you want an income stream. You want some money coming to you post-retirement. You have some goals. 6 months of cruise. Who is going to fund it? Some money has to be paid, right? Do you want to leave a legacy? I have 2 children. So do I want to be paying for their education, school funding, or do I want a business for them? Standard of living, meaning whatever I'm doing, and some emergency fund that we have, right? So benefits of choosing retirement plan for small business. Now we move to the small business perspective, right? Small businesses are struggling from the cash flow perspective every day. I know it. I'm one of them. We struggle from the cash flow side, right? So why bring the retirement planning in the mix? Why increase the expense when I'm already struggling with the cash? But see, if you don't offer it, somebody else will. If you are not doing it, somebody else will do it, and you will lose the employees. With employees independently can choose who they decide to work for, how much money can you pay, right? So the contribution for the retirement planning from an employer perspective, from a business perspective, are tax deductible. So if if you are paying $100, it's really not costing you $100. Depending on what income tax bracket you fall in, it's probably costing you $70, if not $60. The assets that you have in the plan typically will grow tax-free, meaning if I contribute $10 and if it becomes 20, the whole 20 is not going to be taxable. So it's a tax-free growth. Plan options for the business are more flexible than the plan options that you have for individuals. When it comes to business, let's say, take an example. If you take the health insurance yourself, it's $2,000 for the family. But if you have a small group, a business takes it, 5 families can take it for $8,000, not $10,000. So it becomes cheaper, more flexible. And then of course, you're putting yourself higher than the competition just to make sure you are not losing the employees. So there are several benefits of having a retirement plan for a small business. Tax credit, employee retention, putting yourself higher than. So we know there are several benefits. Knowing that we need the retirement plan, we have to start thinking about the retirement plan. We don't have the retirement plan. Everybody else does. How do we differentiate ourselves? These are the main retirement plans that typically qualifies for a small business. I know you're taking the picture and the video. Just so you know, everybody, we'll be sharing the whole video. We are trying to shoot the video. We'll concise it, take the introduction out, make it 20-25 minutes video, and we'll distribute it everywhere, put it on YouTube as well, right? Just in case, right? So these are the main plans that most small businesses will qualify. Again, these are not all the plans. There are several other plans, but they are for bigger business, not meant for everybody. These plans can easily be done. So right from the IRA, individual retirement account, this is an individual plan. Can be funded by the individual, can be funded by the business, right? And we'll talk about the various types of individual retirement account. We'll talk about the difference between the traditional IRA, the Roth IRA. But let's understand, what are we talking about? This is SCP, the most popular plan in any small business. If you choose, give me one plan, one word. What's the most popular plan that every small business has? That's SCP. If you don't have the SCP, now you know you're missing something. Everybody, if you count the number of plans, how many 401ks? In the small business arena, you will find the most popular small business retirement plan. For a big business, is the 401k. For a small business, this is the plan. And we'll talk about the benefits, pros, and where this plan is most suitable. Right? And then of course the profit sharing plan. This is where the pension goes. But these plans are getting less and less popular because they are expensive plans. Profit sharing plans are not there. And of course, if you are one of those guys who have enough money and want to think about leaving a legacy or having this money go to the next generation, especially tax-free, that's when the trust planning comes. A lot of the problem with the small business area is we work very hard. See? You lose the hairs. After working 40 years, you created a business. You created this NASDAQ. But your kids don't want to inherit it. They don't want to do it. What do you do now? Somehow you have to sell it. But the problem is my small business cannot survive without me. I'm the business. For most small business, you are the small business. You are the business. So how do you create a situation when you can create a trust to have this business go to the next generation, or at least some sort of money going to the next generation? So this is not of a retirement plan. That's why you don't see a direct connection here, but it comes from a planning perspective when we think about the retirement plan. So if you go back here, we are talking about the IRA, SAP, 401k, and profit sharing. Most popular SAP, most popular in the larger business area. 401k, individual is more about the individual. You cannot, I don't have enough money, Ajay. I cannot do any small planning, any retirement plan. You should still consider IRA. If not for a small business, not for your business, at least at the personal level, you should consider IRA. That's important. We are not getting any younger. Profit sharing plan, I will talk about it. I'll give you the idea and how it works. Not many business can afford the profit sharing plan. I mean, you have to be really generous about the idea behind the profit sharing plan is whatever profit I make, I'll share with everybody depending on the formula we decide in my business. So not as common. And trust planning is not a type of retirement plan. So at a high level, and these slides will give you these slides. All these slides, we'll print it, give it to you in a bag. We can email it to you if you don't have it, and we'll put the whole presentation in YouTube and we'll email it to you. So whatever, right? Just to make sure that you have this information handy on your fingertips. At a high level, there are two types of, yes, please, there are some presentation printed over there. If you wanna grab one, I should have distributed some. If you wanna grab one, please, be my guest. So at a high level, there are two types of IRA. Individual accounts are of two types: traditional IRA and Roth IRA. The main difference is in a traditional means the way it used to be. Roth is a newer concept, comparatively speaking. Traditional IRA, you put in the money, you get the tax advantage now, but when you take the money out, you have to pay the tax. In a Roth IRA, you don't get the tax advantage now, you put in the money, but when you take the money, just not the principal only, but even the growth, let's say you put $10,000 in a Roth IRA, after 20 years it became 35,000, the whole 35,000, not just the 10,000, everything is tax free. So when you retire, you want to create a nest egg where some money is taxable, some money is non-taxable. So depending on how much money you need, you can play. The way the system works, up to a certain point, the income tax is 12%, then it's 20%, then it's 22%, then it's 24%, it goes up to 37%. It does not include the state tax. State tax is on top of it, 9%. So by the time you are said and done, you are paying 46% tax to the government. It does not include the sales tax, that's 6.625. It does not include the payroll tax, that's 15.3%. By the time you add everything, you are giving 70% to somebody else, right? So you have to play the game. You have to know the rules of this game to play it smartly, to get ahead of everybody else. Everybody in the same situation. Who is going to win the competition? Who has the information? Who has the right accountant, of course. So there are two types of plan, right? The idea is some money has to go here, some money has to go here. You have to create a situation where you have some money pre-tax, some money post-tax. That's why the traditional IRA is more of a pre-tax. You get the tax benefit now. Let's say if you happen to be in 24% tax benefit. AJ, what is my income? Why is it 24? I thought last year I was 22. No, your income is 3,000 higher. Only 3,000 is going into 24. Why don't you contribute 3,000 into my traditional IRA to push my income down so I'm back in 22%? So if you know the rules, if you know how it works, you can play the situation, you can play the game. You can push yourself in a lower income tax bracket by pushing some of the money into the traditional IRA. But Roth IRA is a great idea. The problem with the Roth IRA is if you have more than a certain amount, 144,000 and 214,000. If you, for a single filer, if you are making more than 144,000. For a married filing joint, if you are making more than 214,000. The government does not allow you to put the money into Roth IRA. You are not allowed to put the money. So how the game is played? Well, AJ, is there any limit on traditional? No, not really. Okay, hold on. What if I move money from traditional IRA to Roth IRA? Well, you have to pay tax on that money, right? Because here you got the tax saving. So if you move money from here to here, You have to pay tax. Okay, Ajay, do me a favor, put my 5,000 to traditional IRA. So I got the tax advantage, right? I got 5,000 reduction. Then move my 5,000 from here to here. That's allowed. So you don't have to pay any tax. That's called backdoor Roth IRA. If you don't qualify for the Roth IRA, everybody wants Roth IRA. I have never contributed a single dollar in traditional IRA. For last 22 years, 18 years since my daughter was born, I have been contributing to Roth IRA only. The problem is there is an income limit. So you contribute to the traditional IRA, then have the money transition to the Roth IRA, and that gives you the same concept.
But then, sorry, can I ask a question? But then it doesn't matter on the income levels, the 144 and the 208.
Well, great question.
If the money goes in there.
Traditional IRA has
Right.
no income limit.
Right, but
And
if
there is-
even if you're transferring it, then the Roth, that rule doesn't take over.
They don't. The only caveat, there are certain limitations. The
Okay.
government knows this
Right.
thing, but we still allow it because we want to promote
Uh,
the retirement saving. The only caveat is if you put the money into Roth IRA directly, you can take it out anytime. If you transfer the money from traditional IRA to Roth IRA, you cannot touch it for 5 years. And there are some other limitations as well. So there are certain rules around it, but still, from a concept perspective, it works for most people. But you have to really have a good accountant.
Quick question, when you take money in Roth IRA, you don't need to pay 10% penalty?
If you take the money out from the Roth IRA and it covers your principal, then you don't have to pay the penalty. Meaning, let's say if you are contributing 5,000, 5,000, 5,000, 5,000 every year for 10 years, and after 10 years you needed to take 20,000 out of Roth IRA, no penalty. Because it's still,
There's some percentages.
it's still covering your principal, the money that you contributed from your pocket. So this is the concept I was trying to explain. And again, the whole concept is in your presentation, in the email. The concept here is if you do not qualify for Roth IRA, how do you still contribute to the Roth IRA? How do you contribute it in one line? Find a good accountant. So here we are talking about the simplified employer pension plan. If you remember my slide, I had the IRA here, I had the SCP here, then I had the 401k here, then I had the defined benefit plans here, right? Pension plans here. So this is the most popular plan, simplified employee pension plan. There is no startup cost. Most plans, like the 401k, like the benefit plans, they all have some startup cost for the business. Think about from a small business perspective. A typical 401k will cost you thousands of dollars. A benefit plan, profit sharing plan will cost you even more. And then there are certain filings, 5,500 filing at the end of the year. This plan, no filing at the end of the year for a small business. No cost for a small business. Easy to open, contributions are immediately vested. If you want to do it for yourself, what's the why a lot of people don't do it, even now. Whatever you contribute for yourself, you have to contribute for every single employee in your company. It's that I have, let's say I have 22 employees, and I want to contribute 25% of my salary or 61,000, that's the limit. Then I have to contribute a similar percentage what I contribute for myself. Everybody, say my salary is 100,000 and I contribute 25%, 25,000. Then I have to contribute 25% of salary for every single employee in the company, and that can become expensive. But from a business perspective, there is no separate tax filing for this plan, no retirement filing, and no additional administrative cost. You give the money, and that the money is managed by the employee or one of their representatives. Employer is definitely allowed a tax deduction when they contribute to the SCP. It's considered as a business expense for the employer. Ideal for the small business. Now give me an example. Who will have this plan as an ideal plan? Let's say if I'm a one-man army. I have no employees, me and my wife. This is the ideal plan. You contribute for yourself, you don't have to contribute for anybody. You don't have any. So for more solo practitioners, for most people who do not have payroll or have the payroll for themselves only, this is the plan. You can contribute up to...
Just one question, if may. When you contribute for the employees, it's a tax deduction for the business. Is it a income for the employee?
No. No. It's not an income for the employee. That's the best part. So, and this is Solo practitioner meaning people who are working themselves, one person, one man army. This is the plan that's sort of considered as the ideal plan for them. And you are not required to contribute every year.
Ajay, one question on the
Please.
solo part of it. So if you're a solo today, tomorrow you are not, what happened to this plan?
That's the best part. See, employers are not required to contribute every year. Meaning, you contribute this year, don't contribute that. You can even make it worse. I only contribute to the SCP if you are with me for 2 years. So then you can put a up. There are certain limitations. The idea is to tell you about the plans. Each plan has a book behind it, has a lot of rules, regulations behind it. You can discuss it, but once you understand this plan may make sense. The idea behind the education seminar is to become thought provoking. You have to start thinking about, as a small business, we keep it on the back burner, and by the time we get there, it's kind of late. But that's a good question. It's not taxable income for the employees.
What happens if I have part-time employees? Still they are eligible?
One more time, please. Srini.
Or part-time employees?
Well, there are rules. If you have to have 1,000 hours and you have to have more than, so there are a lot of rules around it. The idea is, if you have part-time employees, or if you have no employees, or if you have 1 or 2 employees, this would be the plan that you would consider first.
Is there a limit for what type of corporation you're set up? LLC, S Corp, C Corp?
Yes. So this plan works with LLC and S Corp only. This plan works with flow-through entities. LLC could be solo proprietorship, Section 34, meaning single member LLC. LLC could be a partnership or S Corp. But this applies only to the flow-through. This plan does not apply to the C Corporation. In LLC, as I was saying earlier, the contribution are limited to 20% of the profit or 61,000, whichever is lower. For S Corp, the contributions are limited to 25% of the payroll or 61,000, whichever is lower. So the maximum is 61,000. You cannot cross 61,000, but there are some rules around it, meaning depending on the plan that you have.
But one more last question before you move on.
Oh,
So can we
sure.
roll up to a Roth in this one, like SCP and Roth?
Absolutely,
Okay.
absolutely. It could be either way,
Okay.
depending on how you set it up.
Thank you.
So this 401k plan is the most popular plan where you have large number of employees. And in my small business world, anything over 5 is large. Meaning, when you have employees, that's the plan you want to consider. The good thing about this plan is, even though I have to give this plan to everybody, but as a small business, I don't have to contribute anything. Unless you're thinking about a plan where you want to contribute something, you are not mandated to contribute anything. The plan comes at a cost. There are certain filings, 5,500 filings that you have to do at the end of the year, some administrative costs, some setup costs, but it's not deal breaker. Couple of $1,000 you should do it depending on how many employees are contributing. You can set a limit as how much money the employees can contribute. You can set limits how much you would match. So you can say, if you contribute 5%, I contribute 2.5%. I'll contribute maximum $500 only. There are rules that you can define, rules that you can place. When you have employees, this is the plan most people will consider in this type of scenario. The plan comes with certain limitations. So the 401k contribution plans are very, very similar to SCP when it comes to the limit. For multi-employees company, 20,500 is the limit per employee. So the employees cannot contribute more than 20,500 in a year in a 401k plan. And these limits changes every year. This limit is for 2022. And if you want to contribute 3%, you can qualify for the safe harbor, meaning you cannot be scrutinized. The plan has to go for certain checkup, certain filings, and the IRS has the right to check if you are doing it right or not. But if you contribute 3% for each employee, then you qualify for the safe harbor situation. Then
Regardless of how much the employee himself contributes?
right, you contribute 3%, irrespective of what they're contributing. Then you qualify for safe harbor, meaning I'm giving enough money, I have no reason to be cheating. Then the scrutiny is not there. It's a special type of plan. Again, this plan is not is well suited if you have the Walmart, Microsoft, Oracle, all these big corporations. Most of them, that's the plan. They won't have.
Ajay, one thing on 401k. So if you're like, if you're an employee and then you move on and start your own business, you have a 401k, you want to move to Roth or SAP, am I paying taxes on that?
Well, if you move any 401k plan, 401k is typically the traditional plan, meaning pre-tax plan.
Correct.
If you move from any plan, SCP, 401k, IRA, anything that you move from pre-tax to post-tax, that part becomes taxable to you.
Correct.
So let's say if your income is $100,000 and you move 20,000, now your income is 120, then probably you instead of 22%, now you are in 24%. So you have to be smart about it.
Mm-hmm.
If you are moving, call the accountant. How much money I should be moving? I really have to move some money. What do you have? I have some Roth, I have some traditional. What is your income? 87,000. You can move 13,000 from the pre-tax, so you still in the lower tax bracket, and then after that you can move from post-tax. So little bit of planning can save you a few $1,000s.
Ajay, regarding 401k, can you contribute 1 year, the next year you can stop, the third?
The plan has to be closed. You can, here, SCP is all flexible. You contribute this year, next year I hired somebody, no contribution. The year after I fired somebody, I want to contribute again, all good. 401k is a plan that has to be approved first, and if you don't want to contribute, you have to be officially closing the whole plan. Then you have the right to sort of start off, but there is an expense to open the plan, to administration the plan, the closing the plan, right?
Thanks.
So profit sharing plan. At a high level, the idea behind profit sharing plan is I make $57,000 every year. I have 20 employees. I want to share $1,000 to everybody. I'll have 27,000. I'm happy with my 27,000. I want to share some money from my profit to all the people. And this is how the older, 50 years ago, pensions plan were created. People say my dad had the pension, not the social security. The pension, the real pension, is the concept that people are not aware of it anymore. In the last generation used to have pension in this country. So there are two types of profit sharing plan here. There is a defined benefit plan and defined contribution plan. At a high level, the idea is here, see, defined plan. The difference is benefit and contribution. Here, the benefit is defined. So take an example. When you retire, if you work for me for 40 years, at 61, I'll give you $2,000 a month. I'm defining the benefit that you will have. Now it's not your problem. How do you get 2,000? It's my problem. Where do I invest this money? How much I have to invest to make sure when you retire, you get $2,000 a month. So the employer, in the defined benefit is defined. Employer is responsible to invest this money. You are not responsible. You don't have luxury to touch this money. You only get, the guarantee is 2,000. So if you think about it, the younger generation has more time to grow the money. If I hire somebody who is already 75 years old and I promise them 2,000 a month from next year, I have to contribute $50,000 right now. This is where the age discrimination came. When you see that you hear a lot of people are not hiring the older folks now because they have the pension plan here. I can't afford to hire the older folks. I have to find a reason not to hire them. I mean, as a small business, I'm being fictitious here. So here, the benefit is defined. So if you think about it, the benefit is fixed. And benefit depends how much I have to contribute, depends on the length of employment and your salary. Employer is responsible. A small business is responsible for all planning and investment risk. Here, defined contribution. As a small business, I cannot guarantee how much you will get. I can only guarantee how much I will contribute to your retirement plan. I will contribute $100 every month. You decide where you want to invest. You decide how much risk you want to take. I'm only contributing a fixed amount every month for your salary. And how much I contribute depends on your salary, depends on the employment. So here, there is no discrimination. There is no age discrimination. So most plans moved from defined benefit plan to defined contribution plan. Even the bigger companies who have the profit sharing plan, nobody has this plan anymore. They have this plan, defined contribution plan. Employee is responsible for the risk of the fluctuation, not the employer in this case, right? Now let's talk about quickly for the trust before we wrap up. A trust is a legal entity other than you and me, a separate entity that we create to park the asset while we are leaving. It's not a will. It's not an estate. They're different concepts here, right? A trust was very, very popular when the limits for the inheritance was 5 million, 3 million earlier. Now the limit is much higher. Now the limit has increased to 12 million. New Jersey does not have any, what I mean by inheritance is if you were to move into the next life, if you were to pass away, how much money can you give to the next generation tax-free? The estate taxes are very high, 40%. So the limit now from the IRS, federal government, central government, is 12 million, 12.06 million. So if you have more than 12 million, you must consider a trust. If you expect that your assets will be more than 12 million in your lifetime, you should consider it. But 12 million is just for one spouse. It's 24 million when you have the married filing joint. There's a filing, 706, that you can file to have the portability. If one of the spouse happens to die, you can file 706 to have the leftover limit from this spouse moved to you. So you get 24 million, not 12 million. But there are certain rules around it. You have to do this filing within 9 months. Otherwise, with that limit goes away. You still have 12 million unless you do this filing, right? Trust at a high level are two types: revocable, meaning you can change anything you want, and irrevocable. Once you make it, you cannot change it. Now take a step back. Let's say if somebody has, or expect, say right now my net worth is 1 million, but I have a lot of years left. I'm really expecting the net value, the total worth to grow to 20 million. I'm being positive. From 1 million to 20 million. What should I do now? Then I have to pay tax, $4 million in tax, 50% tax on 8 million. So what I do, if I can move some of the assets right now into an irrevocable trust, then the asset can grow free in the trust. So when I contributed, the limit counts at that time. Let's say if I contribute my business to an irrevocable trust, now I'm contributing 1 million. I only used 1 million out of the trust. And if this business in the trust becomes 20 million, I only used only 1 million of limit. I already gave it, but it has to go to an irrevocable trust, meaning the beneficiary can misuse the fund. If I make my son is 17 years old and now he's going to the bar, right? So it could be other way around. You have to really think about it. Now these are the two concepts that just sort of a afterthought. Premium funded life insurance, a lot of people think about it now in these days. See, especially with the high net worth people, and you have to have minimum $5 million of net worth to qualify for this plan. If you have less than 5 million of net worth, you are almost done for the presentation. So this plan, so the idea is, let's say if you are going for 20 million life insurance, the premium is going to be $200,000, very, very high. I'm just making up the number. I don't have 200,000. I want the insurance. So what I can do, I can go to a bank, investors bank. They will fund the premium, more of a loan. They're giving a loan to me. I'm using that loan to pay the premium. The premium keeps increasing in value here in this plan. And once the premium becomes sufficient to generate enough cash flow to pay the premium itself and pay the loan. So the policy itself will start paying the loan back after certain number of years, typically 7 to 10 years. And after 20 years, the loan is paid up and the policy has sufficient cash to generate interest, to generate enough cash to pay the premium itself. The premium funded life insurance is a great concept. In theory, you can buy the $20 million of insurance without any cost, just in theory. You still have to pay some money. But this plan only applies to certain, not for everybody. Now, captive insurance is another plan that's applicable to C corporation only, where you can, and it has to be a really, really large corporation. If your company net worth is under 10 million, not for you. The idea is you can create your own insurance company. You can say, if I'm not there tomorrow, there's no business. So what I do, I buy an insurance for being fat, right? So nobody's giving the insurance. I call 5 insurance company, nobody cares. So So I create my own insurance company. My own insurance company charging me premium $700,000. I push this $700,000 into my own company, and this becomes tax deductible over here because it's an insurance cost. It covers the insurance that are not covered in the general market. And this company is owned by me. This company keeps collecting the profit. And after 5 years, I close the company, take the dividend at 15% or 20%, and save taxes at 37%. It's a legal tax arbitrage that's created to save at least 17%, if not 22%, but only applies to large corporation, C Corp only. And you really have, this is one of the top dirty dozen in the IRS schema, IRS scrutiny. IRS publishes a list as how many frauds happened this year and what were the topic. This will always be there. All large corporations try to play this game. So this is just sort of an afterthought. Now here, I'm trying to sell myself now. So here, when the client is confused, you say, I want to contribute to Ajay said SCP or 401k. Let me call my wealth planner. I know somebody good. Well, is it tax deductible? No. For tax, you have to call the CPA. Right? You call the CPA. I have a CPA too. Hey, this guy was saying, is it tax deductible? You have to check with the wealth planner. Okay. And the client is confused. They don't really know what to do. You want somebody who has the CPA and the wealth planning experience and the license. As I said, I was selling myself. So the client is confused. This expert is saying, go to the wealth planner. This is, go to the CPA. So this helps if you have the right experience, right knowledge, right certification to get the right advice. So we can help you in many ways. We have the licenses, we have the experience, we have the exposure, we have the relationship. So these are the frequently asked questions, but before I go to these questions, if any questions so far, please.
So question, for SEP IRA, you're saying 25% of the employee income. So there's W-2 income, and what about K-1 income, like a distribution
No,
income?
not qualifies.
That will not allow you.
Only W2 income. Only the income where you paid the payroll taxes.
Okay, so what happened is, let's say this is April 1st, and you had some employees in the prior year, but you got rid of them in January.
You don't have.
So the date of, so you're, and then let's say you have, that's one scenario, so those employees don't exist anymore.
So from the date you signed the plan, that's the date you will count from the employment perspective.
No, so you prepare your tax return in April 10th.
If they're not an employee
There's
at
an
that
employee
time,
at that day.
they don't.
So let's say you got rid of March 31st.
No, they were employed at the end of the last year. The tax return is done at the end of December 31st.
Okay.
If you fired them before December end, then technically they were not the employee.
They are not employees. So let's say you fire them December 15th. They're not.
Well,
I'm just
in
saying.
theory, you don't have to contribute, but if you rehire the same employee, and if there is any scrutiny, that will be seen as not okay. Then
So,
okay.
quick question, can a company and one entity actually have multiple retirement funds
Yes.
for their employees?
Yes, you can.
You can, so.
Absolutely.
So, and it's not discrimination if I have like a older employee, for example, and I wanna set up, a trust, that type of setup for them.
Maybe you can, you're
Or
talking about,
profit share, I'm sorry.
you cannot do the profit sharing plan based on discrimination, based on the age, but there are certain other plans. You can have the executive bonus plan, you can have the key man plan. There are certain other plans that you may qualify for, we can discuss the situation, but profit sharing plan is something that you cannot do based on certain discrimination.
Is there a deadline for contributing to any of these retirement plans?
There is.
Is there in time frame, like calendar year
Yes.
or the filing
So
date?
absolutely, for every single plan, there is a time frame. There are certain guidelines that I did not cover in the interest of time. 401k plan must be contributed before December 31st. SEP plan can be contributed till March 31st. You wonder why March 15th? You wonder why March 15th? That's the business tax deadline. If you file an extension, then it's September 15th. IRA can be contributed till April 15th. If you file extension, then October 15th. I'm just giving, if October 15th happens to be the weekend, then it's 16th. I'm just giving you the rough deadline. Yes, sir, please, of course.
Sometimes you have multiple companies,
Of course.
like one of them LLC, one of the S
Of course, of
corporation,
course,
C
of course,
corporation.
of course, very common.
So can I participate in all of them, or is there any limitations? Can
You-
I be one SIP, one 401k, one?
Wonderful question, great question. So you can have one plan for all the entities together. You don't have to have a separate plan for each entity. One umbrella retirement plan can have multiple entities listed. What you are not allowed, the question that I typically get asked,
Limitation.
say, if I have a company where only me and my wife owns it, can I have a retirement plan under that company? Let's say Sai CPA Services has 45 employees, 46 employees, right? But I have another company. I can create one company, Sai Consult, and move money from Sai CPA to Sai Consulting, where I don't have any employee. Can I have a retirement plan under my company? That's not allowed. Whatever you offer in one company, they will common ownership test. All the common ownership companies will have to have the same plan. If I have 5 companies, more than likely I have to offer the same plan for all the 5 companies.
Can
But there are some certain rules that we can look at the situation. Yes, please, of course.
So say, example, I work for Investors/Citizens, I quit my job, start my own company. My 401k, which has been collecting, I can transfer some of that to a SEP or all of it, or no, it has to go traditional IRA or
So
a form of IRA,
401k right
Yeah.
now that you have
Yeah.
is a pre-tax amount,
pre-tax amount, yes.
all of it.
Yes,
So it will go into your pre-tax retirement account. You
Right.
can call it anything.
okay,
If you want to keep it into pre-tax SCP,
Right.
pre-tax IRA, pre-tax amount.
yeah,
So the description you will see is a pre-tax retirement account.
okay,
If you want to move it to pre-tax to post-tax,
yeah,
meaning traditional to Roth,
Roth.
then it becomes taxable.
So it's
Just-
more just the header of where it's
Exactly.
going. Okay.
It wouldn't change anything.
Right, okay,
But in that situation, I'm giving a tax, I'm paying tax for entire amount?
If you're converting it to Roth, yes.
Yes, that's what I was
Wha-
thinking.
Whatever
So
you are
what
converting,
Yes.
only that amount, let's say your total 401k is $500,000, and this goes to, you leave the job, it goes to your pre-retirement account.
right.
You don't want to move $500,000 into post-tax, you are only moving 20,000 a year, 30,000 a year.
So what I mean to say was that in my 401k, really it was like I contributed like, if it's $100,000 there, I contributed 50 and 50 was contributed by the employer, or maybe I gained.
Right.
Right, then I move it over here to the traditional Roth, right? From there, when I move $60,000 off,
The whole 60, whatever amount you are moving
uh-huh,
is all taxable at that time, in that year.
in that is, okay,
Nobody paid tax on that
But
money.
you use two words, it's two totally different words.
yes.
Traditional
yes, I
and
realized
Roth
that.
are two different words.
Yes, two
Two different
Traditional
concepts.
is
So
not
I'm
tax
traditional is
free.
tax free, so it is 401k
Roth
traditional and
is-
Traditional is pre-tax.
pre-tax, yes.
And
Similar
Roth
to-
is sort of
yeah.
post-tax kind of concept. So why can't the question that we have, why do I need to do the tax planning? I can just sell my business and give the money to my children. But you can't sell the business. For most small businesses, you are the business. If you are not there, there is no business. So right now, the business that is worth $1 million, if I happen to sort of, then the business is worth $200,000. Right? That's why you need the
business is
pre-planning.
as big as you.
Yes, of course. Okay. So there's some questions which we need to really go through. We have questions like, is it better to have 401k or IRA? It depends on your situation. Depends on what makes more sense for you. Leaving trust and will. Will is typically applicable when you passes away. Leaving trust is a vehicle where you have the right to move as much asset as you choose in that trust. It can be of two types, revocable and irrevocable. In will, you don't really decide what I will move. Once you pass away, everything gets moved. So there are 3 concepts: estate, will, and trust. We covered trust, 2 types, revocable and irrevocable. Backdoor Roth IRA legal? Yes, 100% legal.
Can you cover the 7th one? Catch-up contributions, like if I'm not.
Yes, if you are over 50 years old, more than 50 years old, the government allows additional, let's say 20,500 is the limit for the 401k, right? Here, you see that? It becomes 27,000 if you are over 50 years old. So for each retirement plan, there are certain rules. Yes, please.
Yeah, same question. What happened? I didn't contribute before 50. Some couple of years I missed it.
You cannot really do
Okay.
that. No.
Oh,
You have to come back to that.
Time, I have the time machine.
He has a time machine there.
Yeah, I remember.
I appreciate that. Any question, you're more than welcome to call me. You have my cell number, you have my WhatsApp number, you text me all the time anyway. I know all of you personally. So please come and let's have some dinner, let's have some more drinks, and I appreciate you coming over.
Thank you.
Thank you so much.